Okay, so we are starting marginal costing, or it's actually uh, decision making through cost behavior, or we say cost volume profit analysis, right? So here the main thing is we make the decision based on the cost behavior, right? And we sometimes say cost volume profit analysis. Okay, so why we when we are uh, classifying the cost. I think you have learned cost classification, right? We do cost classification differently using the elements, right? Such as direct cost and indirect cost. Indirect cost we say overheads. Okay. Then there is another classification of cost which is on based on the behavior of the cost. Behavior means how it changes, right? So it's like if it doesn't change with the unit of output, right, quantity, it's actually the fixed cost, right? And if it changes with the unit of output, the quantity that you are producing, we say it is variable cost. That is a classification based on the cost behavior, right? And there are like relevant and irrelevant cost classification. You know, different kind of classifications are there. But mainly for this we need the cost classification based on its cost behavior, which is variable cost and fixed cost. Variable cost means the cost which changes with the output, right? The unit that you are producing, it changes, and fixed means it doesn't change, it's constant, right? So uh, based on this cost behavior we make decisions, of what cost. Volume in the quantity, profit, we make decisions. Okay, right. So we are right now, we know the managerial decisions we can classify mainly into short term and long term. Long term we discuss when we do investment appraisal, we discuss long term decision making, investment decisions, right? Actually now we are in the short term decision making. Now this cost volume profit analysis is a short-term decision making. See, cost volume profit analysis, right? It's a technique used for the short-term decision making, right? And we do the classification of the cost based on its behavior, which is fixed and variable, right? And we have to learn these concept. What are the concept? Contribution, and we have to learn contribution sales ratio, or we say profit volume ratio, break even point, margin of safety, and profit or loss and sensitivity analysis will learn one by one, right? And we can do this cost volume profit analysis using our equations or mathematical approach, right? Or graphical approach. I will teach both of them, right? So that's all. If you learn all this, the cost volume profit analysis is done, right? And you have a 10 marks question in second paper, second part, right? So the how the variable cost is look like in a graphical method. The cost which tend to vary in proportion with volume of output is identified as variable cost. Now you see volume, when the volume increases, your cost is also increasing. We are assuming that the cost per unit, the variable cost per unit is constant. So when your volume increases, the total variable, this is the total variable cost is increasing. Okay, we assume that the variable cost per unit is the same, right, for all the unit. And fixed cost, we know when the volume changing, even in zero you have a cost, and even in 1000 or 100,000 your fixed cost is same. But fixed cost is also changes after some point, certain point it will tend to change, right? So in short term decision making purpose, we classify the cost as fixed and variable, right? Okay. Now what are the example? Rent expense. For fixed cost, examples are rent expense. Rent you have to pay, factory rent. Even you don't produce any goods, you have to pay. Insurance charges, right? Factory insurance, something like that. And variable cost are commission on sales. When your sales are increasing, the commission expense also will change. Direct materials, direct labor, these are direct costs also, right? Okay. uh, so cost volume profit, as I said, it's sometimes called marginal cost based income, and you have to learn these concepts: contribution sales ratio, contribution break even point, margin of safety, current and expected profit, and the sensitivity analysis, right? And we can do this using the equation method and graphical approach. Okay, I'm now moving to the Excel, right? There is a format that you have to learn. Okay, is my Excel visible to you?
Yes, sir.
All right, I think another person joined. Right, I think who joined? uh,
Farooq.
Farooq, right? Farooq, we are doing marginal costing today, right? I just explained the things, right? In marginal costing, or we say, it's actually cost volume profit analysis. We are doing cost volume profit analysis, which is based on the cost behavior, right? So cost behavior means we classify the cost mainly uh, in different ways. One way of classifying the cost is based on its behavior, how it changes, which is fixed cost and variable cost, right? So main thing in this analysis, we use the cost as fixed and variable. We don't classify as direct and indirect, right? As you did for overhead costing direct and indirect. But here we don't classify that which at all. We classify the cost mainly as only fixed and variable, right? So using that, we do some analysis we call cost volume profit analysis. We do for cost, volume and profit analysis. Asif, right? And I was explaining that we make two kind of decision: managerial decision, short term and long term. Long term decisions we have discussed: investment appraisal. Long terms are investment decision. Now we are in short term decisions. So in under that, the technique used is this cost volume profit analysis, right? For that, we classify the cost based on its behavior, which is fixed and variable, right? And we have to learn this concept: contribution sales ratio, break even point, margin of safety, and we have to do this sensitivity analysis. So we can do this cost volume profit analysis using equation or mathematical approach, or we can do this using the graphical approach. First we'll do in equation or mathematical approach, right? So these things only you have to learn. Okay, I think you can see my Excel,
Yes.
right? So here in this cost, volume and profit analysis, we say it's the marginal costing, right? Why we say marginal costing? It's like that we usually use the variable cost more here, right? So mainly we do the cost classification. Cost, we split it as fixed cost and variable cost. This is our main cost classification. We don't split the cost as direct or indirect. Okay. So what happens here is, this is the format, right? If you know this format, you can do this sum. What is the format? You need the sales income. You need the sales income, right? You need the sales income. Then you deduct the from the sales income, you deduct the variable cost. Now I'm talking about total variable cost, total sales income, right? First we need the sales income, then we need the variable cost. If you deduct the variable cost from sales income, you get something called contribution. It's a new thing, huh? Learn it. You get something called what? Contribution. And from that you have to deduct the, now we have already deduct the variable cost. Now when you see variable cost, both direct variable cost and indirect variable cost, both variable cost which are directly relevant to our manufacturing, we say direct or prime cost we say, and indirect also, if it is variable we have to take, like sales commission, you know. So it doesn't matter whether it's direct or indirect. If it is variable, if it changes with the level of output, you have to take it, and you deduct that from your sales income. Then the remaining is what we say the contribution. The remaining of income, sales income after deducting your variable cost, is what we call contribution, right? And from contribution we have to deduct the remaining cost item, which is the fixed cost. If you deduct the fixed cost, the remaining is what we call as net profit. Let's say I'll put numbers. Okay, I'll put numbers. Let's say your sales income is 100,000. Okay, you produce how many units? You produce, let's say, uh, quantity or output is, your output is 10,000 1,000 units. During the year you produce how many units? 1,000 units. Okay, and your sales price, selling price per unit, selling price per unit is what? How much? 100, no? Then only 100 or yeah, 100. Then only you can get 100,000. 100 is for one unit selling price, and you sold how many units? 1,000 units. So your variable cost, total sales income is 100,000 during the year. And what is your variable cost per unit? I said your variable cost per unit is same. Let's say your variable cost per unit is 20. For one each unit, you have to incur variable cost of 20, right? So your total variable cost will be uh, 20 is for one unit, and your output is 100,000 thousand. So it will be 20,000, no? It will be how much? 20,000. And I can straight away put it in a bracket. Yeah. So what is the remaining? Or we say contribution. We say contribution, right? So you are, after deducting the variable cost, total variable cost, you have remaining 80,000 from your sales income. We call that contribution. Remember, okay, contribution. It's a word you have to remember. Then from contribution, let's say your fixed cost is 50,000. Fixed cost is how much? 50,000. So you have a profit. Now you deducted both variable cost and fixed cost. All the variable cost will come here. It doesn't matter whether it's direct or indirect. All the fixed cost will come here, right? So the net profit is how much? 30,000. This is how you calculate your profit. Just forget the other methods. In this cost volume profit analysis, or in marginal costing, the profit is calculated like this. Marginal costing or cost volume profit analysis, the net profit is arrived at how? From the contribution by deducting the fixed cost. How do you arrive at the contribution? From the sales income you deduct the variable cost, you get the contribution, and from contribution you deduct the fixed cost, is the net profit. Okay, right? So same thing we can do like this also. How? Now this is very